Welcome to the daily update, where I'll go over the action in the market for Wednesday, April 16th, and we'll see how things look for Thursday, April 17th. The markets will be closed on Friday in observance of Good Friday. So Thursday is the Friday this week, and it'll also be monthly options expiration. So that might be a little bit different as far as volume, volume and it's not a quarterly expiration, so we'll have to see if there's a real pickup in volume there, but typically there is. We're looking negative. We're negative across the board now. Short, intermediate, and long term. We have downtrends in all three time frames, and the market's really having a difficult time getting some footing. And to this point anyway, it looks like any recovery we've had is just a bounce. Now we have to kind of shift our thinking a little bit because the S&P is in a long-term downtrend as measured by the 50 period moving average going below the 200 period moving average. And so now we default more to the negative side, where for the last few years we've been able to default to the upside. Now things can always change, and there could be some really big up days in the midst of a downtrend, just like there's some really big down days in the midst of an uptrend. But we just kind of have to shift a little bit, realizing that there's 30% of the time when the markets go down. And we're in it on a trending basis now. We've been in it for a while already. It kind of goes back to November, December 2024, even though we hit an all-time high in December and then we hit another one in February. We've been seeing the steam coming out of the market. We're just not seeing that strength that's really carrying things through. And then under the surface, the things that we analyze and look at just pretty much suggest that. Okay, so right at the open, we had some news that came out after the close on Tuesday that NVIDIA is getting hit with a pretty high tariff. They announced that, and the futures just tanked right after Tuesday. That carried through over through the night. We tried to show some improvement after Europe opened, but then things just got taken back down. By the time we opened in Wednesday's session, we had a gap lower. Now the ranges for Wednesday were pretty small because Tuesday's trading range was small, and the intraday pivot points are calculated on the previous day. So for us to get to S2 was not that big of a stretch. So we did open at S2 at 53.47, and then we tried to rise, but we stopped just under S1 at 53.72, and then we just kind of drifted lower back under S2. Then this is when things started to pick up. Jerome Powell gave a speech. It wasn't really well received. Doesn't seem to have a lot of answers to what's going on right now. And this is when we broke below 5,300. This is later in the day. That's why I just watch the open, just kind of observe things as they're going on. But then it's later in the day when the smart money comes in and takes over. And that's just about when things started to break. So we did go below 5,300. We got below S3, which I had to break out the pivot point calculator. And that was at 52.83. We declined down to S4 at 52.19. And so we were still above that 5,200 level, and we were able to rebound a little bit to close below S3. We were down 2.24% on below average volume. You've got folks that are really confused right now. And this could be somewhat encouraging, the fact that we saw a decline with volume dropping off. And as I said, across all time frames now, based on moving average crossovers and where we are in relation to the short, intermediate, and long-term moving averages, we're negative. Now, interest rates are coming down, and that could help things. We're not seeing the wild move up like we saw last week with the 10-year yield. But all this has to do with tariffs and what's going to happen with the economy. And you can go back and forth. I mean, you can justify that the economy is going to hold up and be okay. You can justify that we're going to see some weakness. Not really seeing an awful lot of strength coming into the economy, at least right away. But that's the hope that down the line, things will actually start to shift and we'll see more growth. Okay, so some comments. NVIDIA, they ended up being down 6.9% on the day, and that just took the S&P futures down. It took the NASDAQ 100 futures down. And they're such a huge company that they have such an impact, whether they're going up or down. And they announced that it expects the first quarter results to include a $5.5 billion charge due with the export restrictions from China. AMD, which is another chip maker, they were down 7.4%. They also said that they might get hit for 800 million. So not really good in that regard. Then Chair Powell said that he doesn't think the Fed will make progress in its dual mandate goals. The Fed, when they were created, they're supposed to help promote an environment of full employment and keep prices stable. And to have the chairperson come out and say, "Well, I don't think we're going to be able to do that," that doesn't vote a lot of confidence, because the Fed has become a big part of, it's always been a big part, but especially since the great financial crisis, they've been the real focal point for the markets. And it's supposed to be the other way around, where the markets do this and they do that, and then the Fed is supposed to react to what the market does. Now it's the Fed does something and then the market reacts. The whole relationship has shifted. And when the Fed comes in and does something to try to calm things down, that's called a Fed put. A put is an option that, again, I teach this in my program, uh, to hedge. So that if you are in a stock or in an index and you think it's going to go up, but you're not quite sure, you not only buy your investment, but at the same time, you buy a put option. So just in case things go against you, you're not going to make any money during this time. But if something goes down, the value of the put option goes up. And so when things are finally finished declining, you sell the put to replace what was lost in your investment. So you break even at that point. And I heavily rely on that in the program that I offer. And feel free to check it out. There's a link right below the video here to go check out the program. And there's called the Trump put, where he's going to step in and say something that helps the markets go up. The Fed comes in and says something or does something that helps the markets go up. Doesn't really seem like that's happening right now. Okay, the VIX were back even further above 30 than we were. This is the market really struggles when the VIX is above 20. And we've been above 20 now for quite some time. We actually got above 40, 50. Now we're back above, we dropped a little bit, but we're above 30 here at 32.64. That makes it a really difficult environment. And I have a chart that, yeah, there are exceptions to that, but it depends on the bigger picture context of what's actually happening, and things are quite negative right now. Now we have death crosses pretty much across the board. The S&P now is in a downtrend where we've been working off a golden cross since early 2023. The NASDAQ's already been on the list. The NASDAQ 100, that is a recent addition, where then we've had the small caps, mid caps, micro caps. They've been weaker for longer now. The Wilshire 5000, and then the bank ETF. Now, the financial sector is holding up okay, and it's in a pretty good uptrend, but the banks that are inside of the financial sector, they're showing some weakness. And so we want to keep an eye on that, especially the smaller banks like Republic Bank, Silicon Valley Bank, New York Community Bank. These really sent some waves going through the markets, and we're just kind of on watch. We always keep an eye on that area. Then on a short-term basis, we have the rate of change short-term, which is based on 10 periods. That's looking extreme negative. The slope oscillator, which has been trying to improve, but it's still extreme negative. The MACD is actually crossed over positive. It's above its moving average, but still giving us an extreme negative reading. And we're back to being far away to the underside of the 20-period moving average. That's what the boom indicator measures. And we're still extreme positive, believe it or not, with the Stochk RSI. It came down, but it's still liking what it sees for the time being. And then intermediate term, we have the TTM squeeze, which had been improving. Now it's not. The price momentum oscillator, a lot of the momentum oscillators were trying to improve after getting extreme negative. Well, they're slowing down with that improvement now with the decline that we saw. The Sean trend meter is extreme negative, the Copic curve, another momentum indicator. And we're also far underneath the 50-period moving average as measured by the boom indicator. And we're getting kind of extreme with our 150 and 200 period simple moving averages. There's a couple of extreme areas that I mark on a chart, and we're getting kind of far away from that, just meaning that we're extreme negative, but it also feeds into this we're overall negative scenario. No changes. When you have the Fed chair come out and say, "I'm not really sure what to do here," I don't know, I don't know, I don't know. That's not a real vote of confidence there. But overall, the Fed seems to be concerned that inflation's going up and that the economy could be going down. They're just worried about that. The dollar was down. We're back under that 100 level. There's some speculation out there that this may not necessarily. I've been pointing out that maybe China is trying to drive the dollar down. That, in depending on how you look at it, that would actually be to their disadvantage because they peg their currency to the dollar and they own $1 trillion of bonds from the U.S. and that's debt that they have to pay the U.S. And if the value of the dollar goes down, it's like they're still, it's like they're not paying back as much. It's more advantageous to the U.S. and China doesn't really want to be that advantageous to the U.S. these days. It could be a policy of the government itself. The markets like a weaker dollar. We've got this massive debt that we're trying to pay off, and a lot of that to Japan, China, other countries, and so forth. And devaluing the currency, at least in the short term, could help pay some of that off. Now, that's not a necessarily official stance. It's not necessarily what's really going on, but that's one scenario that we just throw out there just as a possibility. Because a lot of times we're not going to know what's really going on until down the road. But that doesn't help us right now. We have to try to figure out these things in real time. And even if we're not necessarily correct about a scenario that we come up with, we still put that on the table as a possibility while we just try to evaluate where the markets are at. But interest rates are coming back down, and that's more encouraging. We're not seeing this run to the upside like we saw last week. We closed at 4.28% with the 10-year yield, where we had been at 4.32% on Tuesday. Okay, then sentiment, we cannot get above that 25 level. And with the down day, we're back down to 14 with sentiment, where we had been improving all the way up to 19. And we're back to inverted with the 10 to the 3 month yield curve. Now, most people follow the 10 to the 2 year yield curve, and I do. That one's looking okay. That's not inverted right now, but the 10 to the 3 month, it goes inverted, then it goes back to being normal, but now it's slipping back into being inverted again. We're negative with our trend. The ADX is still below its moving average. Now, if we see more follow through downside, we could turn up and actually show that the trend is beginning to get stronger again. Doesn't mean the trend's going away, and it doesn't mean we're going to stop moving. It just the ADX was really going up as we were going down, and we've been kind of calming down a little bit as far as price until Wednesday, and then we kind of settled things, and that just shows that the trend is not as robust as it was before. So we're still below the moving average. And of course, with the down day, our bias is negative, and I've changed our momentum back to negative. What we did, I'll show this on the charts, we came right up to the 20 period exponential moving average and the midpoint of some of the studies that we look at, and we just can't seem to break above that. And that's indicative of, okay, we're seeing a nice little bounce here, but then it quickly runs out of steam and turns and goes back down. All right, so the economic reports that came out every week, we get the MBA mortgage applications. Massive increase in interest rates last week, so not really a surprise that we were down 8.5% with the applications, where in the previous week we were up 20%. Retail sales, this was the big economic report of the day. It was up 1.4%, which is okay, maybe kind of strong. But is this people buying things ahead of all the tariff impacts? They're running out buying toilet paper, buying all these things because they're afraid that prices are really going to go up in the near future. So, but anyway, on the surface, this showed an increase and came in a little stronger than expected and up from the previous reading. When you take out automobiles, it was up 0.5%, which is also greater than the 0.2% they thought was going to come out, but down from the 0.7% that we saw last time. Industrial production did decrease down 0.3%, which is what they expected, but last time we had this reading, it was up 0.8%. Capacity utilization came in a little weaker than expected at 77.8. They thought it would come in at 77.9, and it's down from the 78.2 that came out last month. Business inventories, this I'm kind of keeping a little closer eye on this because if companies are making products and they can't export them because of all the tariffs, we might see this number really go up. And so it was up 0.2%, but less than the 0.3% they had expected. Last time we did get a reading of 0.3%. Then the NAHB Housing Market Index came in at 40, a little stronger than the 39 that was expected. And also we saw 39 last time. So here's the MBA mortgage applications. We just look at this for informational purposes, just to see what's going on, both with initial mortgages and then refinancing as well, where we saw a decline in the latest reading. Year over year, retail sales kind of flattening out, not really going up, but not going down either, which is often what you see before a recession. Now, there's a lot of other things that we look at to try to determine if we're going into a recession or not. We don't just base it on the fact that this line's going sideways year over year. Month over month, though, where we had a decrease and we saw an increase with retail sales, then production here, the blue line is actually kind of flatlining, but it is still positive. Capacity utilization is also going sideways right now on a year over year basis. And this looks at it and breaks it out in capacity utilization where we're coming back down. We're still just a little bit under that 78% level. 80% is considered to be full capacity, that companies, all the factories are humming, all the tools that they have, everything that's available to make things is pretty much full on at that point. No, we're coming down a little bit below that 78% level. And then month over month, we did see a decrease in production. And then business inventories, still positive, but coming down from the previous reading. And then the housing market index, seeing a bit of a pickup there. So, okay, then looking at this, this is put out by Real Investment Advice and then posted on Isabel Net blog charts. And this is just showing there's an awful lot of uncertainty. I don't know how they measure this, but somebody crunches some numbers and there's just not really a surprise. This just shows it in graph form here that people are not sure what's going to happen. And when they're unsure about things, we see the red line, which is the S&P, coming down. When in doubt, sell. Okay, this is the one with the VIX that there can be times when you buy when the VIX is high. It's supposed to be when the VIX is high, time to buy. And some people really do that. When the VIX is low, it's time to go. But it just kind of shows something when we get a very high VIX reading. Sometimes it might work out, sometimes it doesn't work out so well. I wouldn't base decisions around this. Okay, and you have to know the context of what's actually happening at that time. What they're showing here, this is during the great financial crisis, I believe, and then this is during the whole COVID crash that we saw there. So different scenarios going on. Then Goldman Sachs is coming out saying we expect growth for GDP will be only 0.5% in 2025. And that's also coming down here with the Bloomberg consensus. Okay. Then trends in inflation and okay, try that again. Corporate profitability have had the largest impact on S&P valuations. And we are seeing that coming down. The Schiller PE ratio, which I go over in the intermarket analysis video over the weekend, that has been coming down, but it's still very high. And then they have a model here that they compare that to, and it has been coming down. Deutsche Bank, what are they forecasting? The Fed here? Well, you look at the blue line, and that's the Fed funds rate, and that's real. That's what we see. And then everything forward is like, oh, this is what we think is going to happen. These blue triangles here, this is the Fed, and this is what they now come out with to see what they think is going to happen going forward. And then these red triangles here are Deutsche Bank, and these kind of gray squares. This looks like, some kind of a video game here, like an old Pac-Man or something. And the Bloomberg consensus, that's the gray boxes here. But they kind of see it going sideways to slightly lower. At least that's what the Fed thinks. They're still anticipating doing a rate cut. But we have to know what is the context of that rate cut. Is it because the economy's falling apart, or maybe because the economy's doing okay and they just want to help it keep on moving forward? Then this is another thing that when I've been doing the videos the last couple of weeks, I've been really focusing more on the overnight session. Now I always look at it, but it sometimes it has more of an impact and sometimes it doesn't. And over the last at least brief period of time, the yellow line, this is overnight trading, and this is when we're seeing a lot of the damage being done. That's why we have a big gap lower or gap higher. And then a lot of times the action within the day itself is rather muted. And so that's why I'm always watching this. And I would recommend going to a site called investing.com. You can watch 24 hours a day, 6 days a week, because they close on Saturday. You can watch the futures trading, and it's a free site. And I'm always watching that, whether I'm out and about, I'll look at a phone. Not that I'm participating, but just keeping an eye on things, just to kind of get a feel for what's happening. Because a lot of us, we're distracted by all these other things in our lives, and then we come in and we sit down at the computer and we need to make some decisions without necessarily knowing the context of what's going on. And I found on a personal level, this really helps me to watch the markets all the time, even when I'm not actually participating in them, just to get more of a feel for that overall context. Okay, anyway, market returns have been driven by a binary spread between tech and other sectors. So binary, ones and zeros, just on off type of a thing. World tech has been coming down, but it's still the major performing area where you take out this tech and the results are not as robust there. Then this is what I was showing with the 10 to the 3 month yield curve, where we're actually dropping down and going inverted. When they did this chart, we went back to being normal again. Well, as I just said, we're back to being inverted. So this chart is actually a little out of date here. So we did see some weakness, and then that led to the gap lower open below S2. Never made it up to S1 here. But because Tuesday's session was so comatose, that made Wednesday's pivot points really close to each other. And so it looked like, okay, we're going to have a gap lower, but the market was trying to do a little bit of recovery here. That didn't last very long. We ended up drifting lower below S2. And then this is about the time that Jerome Powell was stocking. This is when the smart money comes in and does what they're going to do. And that drove us down below S3. We got all the way down to S4, just a little bit above that. Then a bit of a bounce going into the close, but still closing below S3. And seeing a bit of a bounce right now, but we're still pretty much flat in the initial overnight session for Thursday. Not really seeing much of a change here. Both growth and value are getting hit right now. We were seeing some overall improvement, but no real leadership. Yeah, they're both going back down. And we were starting to see some improvement with the S&P growth to value ratio, but there's been no follow through to this point. We ended up going sideways, and now we're showing some weakness here. So end of day, we were down massively. Growth down 2.88%, where value was down too, but a lot less. Down more with the mid caps and also down more with the small caps. So that tends to hurt our growth to value ratios here with the small caps, which are actually looking a little bit better, even though the index is not looking all that good. And mid cap growth to value is still under the 50-day moving average, and we're now seeing a recent death cross with this ratio when we look at S&P growth to value, and not really showing any strength here with this growth to value ratio between these two ETFs. Discretionary, not doing very well these days, below both of the moving averages, and really underperforming staples, which is more defensive. And our trend, we're still below the moving average, and the ADX is declining, but we're negative because the red line is above the green line here. And now it's starting to go back up as the green line's going down. We're still below the moving average in the short term, so that suggests a weakening trend. If we continue to fall, this will probably turn back up. And it's also negative because the red line is above the green line. Volume is below average, as shown here, a little bit up from Tuesday's session, but still below average. Okay, still seeing heightened fear here with the Ultra Index, getting a very high reading there, going back up further above 30 now with the VIX on just looking at the VIX. And when the VIX goes up, the VIX of the VIX also goes up as well. And but we're coming down. Now we were getting such high readings with the VIX and it's coming down. The MACD is starting to suggest that the overall momentum is negative. We'll have to see if that is able to last. And we declined with this fear gauge and we're up with this other fear gauge. So we're seeing some mixed signals there. Going up with the daily chart of the equity put call ratio. We're going up with the 5-day chart and the 10-day chart. That's just showing more fear, more hedging going on, but still getting a very low reading when we look at volatility risk premium, kind of out a little bit out of character compared to the other sentiment gauges that we follow. And we probably overdid it with an advanced decline line percentage basis. We had a big downward move here. That's giving us just a daily reading that's a little bit extreme negative, meaning that we might have overdone it to the downside on a percentage basis with the advanced decline percent. And still above the moving average with the advanced decline line based on price, below the moving average based on volume. So it's positive here overall, but we are seeing some weaknesses that have both been declining. And we're seeing our advancers, decliners, the oscillator here begin to show some weakness after it had been improving. It never did go above zero, but it was improving. Now it's back to looking more negative. And we're seeing internal weakness here in the S&P where we're not really seeing any new highs being generated. It's a lack of new lows. That's what was trying to turn our 5-day back up, and it was starting to level off our 10-day moving average here, but it's not really showing any strength. It's just showing a lack of weakness. And even with the downward move, since we were just in this range not too long ago, we didn't see any real escalation of new lows. We're just barely above the moving average here with accumulation distribution. So this smart money indicator is still hanging on to being positive. But when we look at the advanced decline ratio, both in the short and intermediate term, they're back to negative. This other smart money indicator, it's kind of flattening out here. You could say that it's negative. You could also say that it's more neutral now because I tend to follow the red line. But the smart money indicator number two is showing some weakness where we're just flat out negative with the Chaikin oscillator, although we're still above the midpoint or above zero. Negative with the vortex. The red line is above the green line. The advanced decline studies that we look at showing weakness, we'd come back up to the moving average with the S&P. Now we're starting to go back down and showing more weakness with the mid caps and small caps. The percent of stocks above their 20-period moving averages had been improving, now is going back to declining. We're also declining with the 50-period moving average study, 100-period moving average study, and starting to get extreme again with the 200-period moving average study. So this is the death cross, and it's a little hard to see because we have this R1 point in here right here. But the blue line is now below the red line. That means the longer term trend is negative. And then we look down at the bottom, we are below average with volume on a 1-day rate of change because Tuesday was so sleepy that we probably overdid it, at least on a day over day basis here to the downside. And we had been seeing some improvement with our moving averages, but now they're starting to show weakness again with the 20, 50, and 200 period moving average study. We're coming down, but we're still extreme positive with the Stochk RSI. It liked that upthrust that we were seeing, but it's not really seeing much follow through here, where we're just about at the midpoint with the Williams percent R, dropping below the midpoint with the CCI 14 and the CCI 20. And nothing extreme now with the short, intermediate, or longer term stochastic, which is subdividing the short term time frame. We were going positive with the force index. Now we're back to being negative. The condition of the short term trend measured by 20 periods, we were trying to stabilize here and possibly even improve. Now that improvement seems to be fleeting. And we came right up to the midpoint here with our standard deviations chart. We hit that three areas here, but just could not get above it. And that's kind of a unofficial line in the sand between positive and negative. Because if you're above the midpoint, that's more positive. If you're below it, that's more negative. And the rate of change, short term here, going back 10 periods, we were showing some improvement. Now we're back to looking extreme. Also, the 20 period rate of change is not really that far extreme, but it's coming back down to this pink line. And then this is a variation, or at least an alternative to what is inflation doing. And this is updated every day. It's called Trueflation. It has inflation coming in at 1.36%. So we're just kind of testing this one out. Intermediate term, below the midpoint and declining with the balance of power. Not really turning full-blown negative with the go, no-go, but it's the lighter shade of purple. This is another midpoint. Same midpoint as on the other chart I was showing, acting as overhead resistance. And the TTM squeeze was trying to improve, turning the lighter shade of red. Now it's turning darker red and getting extreme negative. So it's picking up the weakness that we saw on Wednesday. Standard deviation, we have slowed down a little bit with the movement of price, but it's still quite high. And we're negative with the ease of movement below the midpoint and now back to declining after it had been improving. We're negative with the Arun since we're below zero. We've dropped back to negative again with the S&P McClellan oscillator. We were above zero. Now we're dropping below zero. So we're starting to go back down with the summation index based on price and volume where we had been positive. Hanging on to just barely being positive with the NYSE McClellan oscillator since we're barely above zero. So we're just ticking up ever so slightly with the summation index based on price and volume. And we were positive with the Swindler trading oscillator. Now we're turning back down with both. So that's turning negative. Momentum was trying to improve after being extreme negative and trying to come back up to its moving average based on price and volume, but not quite there. And a little bit of weakness here with the PMOs that are rising. We're still going up with the buy signals, and we're seeing a little bit of an improvement here with the PMOs that are above zero. We've gone from positive to negative with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. This is a primary indicator that's still saying that we are positive. And we're still extreme here with the slope oscillator, a short-term oscillator, but has not been able to get back above its moving average. The MACD has crossed above its moving average after getting extreme negative. So, we're really choppy right now. And these oscillators move slowly, and it's trying to pick up some kind of a trend. We're still positive with the TSI, but we're negative with the slope. Those are the short-term oscillators. We are improving in the intermediate term, but we're still negative with the long term. And the copy curve is still giving us an extreme negative reading and is negative there. Just to give it more context, I wanted to include a longer term version of this chart. And we're still below 50 with the money flow. We tick down and still above 50 with the ultimate oscillator. We're starting to get extreme negative with the Sean trend meter. We're below the moving average with unbalanced volume. That's negative. And we're below 50 with the intermediate and short term RSI, which is negative. This is the condition of the intermediate term trend. The blue line and the red line continue to decline, so that just shows weakening is continuing there. We're below all the moving averages here, and it's hard to see, but there is a death cross in here somewhere where the 50 period simple moving average, which is pink, it's falling below the 200 period moving average, which is the dark gold. So that's turning more negative there. We're extreme when we measure the distance that we're below the 20 and 50 period moving averages. And we're extreme with the rate of change going back 50 periods. We were trying to improve here, but right now it's going back to showing more weakness. But this is kind of encouraging, I guess. We're still going up with the bullish percent index. We're above the moving average, and we did advance slightly on Wednesday. We're still showing a bit of an improvement with the NYSE bullish percent index, and we're ticking down, but we've been showing some improvement with the NASDAQ 100 bullish percent index. This is a bigger picture look. We're watching the ratio between the SPY, which is the ETF for the S&P, and staples, which is toilet paper and toothpaste. We saw a real breakdown of this in late 2021 before we went down with the market. We've been seeing a breakdown over here, wondering if that same type of scenario is playing out. And the mass index, just wondering if there's some kind of a signal that's going to be generated there. All right. And then we're back to below this long-term trend line. This red line goes all the way back to the 1987 crash. And we had been able to recapture that. Now we're falling back down below it. And we're turning more negative here with the Heiken Ashi. And we're negative and pointing down with the Kegi chart. We're still positive with the Renko chart, and we're still positive with the three-line break. So seeing a bit of a mixed picture there. And we had enough of a downward move to have some O's drawn in here to the point and figure chart, but no signal is being generated currently. Long term, we're getting extreme with the 150 and just barely below this line here with the 200. These are just reference points here that when we go below the green line up here, that just means we're getting kind of far away with the movement of the longer term moving averages. And we're still not really seeing a change here. Everything's negative except in the long term, the S&P. Now I have this as being negative based on how I measure it, and the NASDAQ 100 is still positive, but we're negative with the mid caps and small caps longer term, and every other time frame is negative. We're negative with commodities in the short and intermediate term. Dollar's still negative across the board, and now bonds are switching to being negative based on price on all time frames. The only sector that was up was energy, which often tends to be more defensive. Look at the weak areas, tech, communication, and discretionary. They're the ones that saw the biggest declines. Those are the three big growth areas. And lots of red, few green or blue in here. But Canada, well, they were looking pretty good right at the start of the day. They had a bullish MACD crossover. Then industrials are looking weaker. That's more economic driven. The financial sector is showing some improvement with a bullish MACD crossover. That's good. The dollar went back below 100, and then the NASDAQ 16, 8, 7, 6, 5, 4, 3, 2, 1. A lot of the alerts are just as the NASDAQ's been going down. And then real estate, because interest rates have been falling, that chart's improving a little bit. Materials are improving a little bit. And then we had a BPI cross for the NYSE above 30. That's been one of the indexes that's been holding up better. Now it's negative. It's still not switched over to a downtrend. So we're kind of hanging on to that for a little bit of hope because there's value in there as well. The Dow getting really close to a death cross, but not quite there. But going from positive to negative with the Elder's Impulse system for the diamonds. The NASDAQ, this was generated last week. We do now have a downward trend here. And we are negative with the Elder's Impulse system for the NASDAQ. And here's the NASDAQ 100, a more recent addition, crossing over negative and also negative when we look at the cues for the Elder's Impulse system. The momentum is still positive, but another day or so of downward movement, that's going to turn the momentum back to negative. Small caps, they were about the first to go negative here, and that's a downtrend with the S&P 600 as well as the Russell 2000. And still neutral though with the Elder's Impulse system for the small caps. Mid caps also in a downtrend and still neutral with the Elder's Impulse system. Financial sector, a little bit stronger, but we're hanging out below this 200-day moving average, which is causing the blue line to roll over more. We want this to stay strong. That just shows that things are going okay in the economy. We want the financial sector to do well. But the bank ETF, seeing a death cross here. That's negative. Wilshire, broad market measure, recent death cross here. Starting to see more of a pronounced death cross here with the total US stock ETF. The FANG index still has a ways to go, but we're hanging out below its 200-day moving average. These are the really big stocks. And then Apple was down 3.89% and is currently in a downtrend. And close to a downtrend is Amazon. Haven't quite crossed there. It was down 2.93%. Excuse me, Microsoft, it was one of the first big companies of the Magnificent Seven to go negative, and it was down 3.66%. Google in a downtrend, down 1.91%. Meta holding up a little bit better, but also spending a lot of time under its 200-day moving average, down 3.68%. NVIDIA was the big stock that gapped lower and in a downtrend. Tesla seeing a death cross here, hanging out below its 200-day moving average, down almost 5%. Netflix also holding up a bit better. It was down 1.5%, but at least it's up to its 50-day moving average. And we're seeing still a pretty strong short-term relationship between U.S. and world stocks, showing a little bit of strengthening there. But you can see this, they're going in opposite directions right now. Oil is still hanging out near the lower end of the 60 range, and the dollar is under 100. And then we look at the decline here with the 10-year yield. That would actually be more positive. This is the big move up that we saw last week. And so we're going up based on price with the 10-year. And we're back to being inverted again. Not very much, but still inverted. Is the 10 to the 3-month yield curve. Not much of an improvement here. When we look at our growth to value ratios, the Qs to S&P showing some weakness, declining with discretionary to the S&P falling under the moving average when we compare large cap growth to value. Coming down back to the moving average with the large caps, still above the moving average with the mid caps, and actually small cap growth to value was actually doing pretty good. It's pulling back, but the moving average is still going up. So what's our outlook then for Thursday? On Thursday, the European Central Bank will be meeting and they are expected to cut rates 25 basis points, which is 1/4%. And the markets will be closed on Friday for Good Friday. And we are negative in the short, intermediate, and long term. Now, we'll get initial claims and we'll get housing starts and building permits that'll be coming out, as well as the Philadelphia Fed Index. And then just whatever the current interpretation is of what's going on with all the tariffs, realizing that there are other geopolitical events. There's still stuff going on in Israel. There's still stuff going on between Russia and Ukraine. And then the market will be closed on Friday. And here is a look at the projections, which has kind of been the same number that we've been seeing for quite a while now for initial claims. Seasonality neutral to positive for April 17th with the Dow and S&P, where we're negative with the NASDAQ. And we are dealing with options expiration, where we tend to be up 67% of the time, going back to 1980. And during a post-election year, not really seeing any real edge, a little bit of seasonal weakness here. There's one way to measure, there's a lot of different ways to measure this. This previous chart, goes back over the last 20 years. This just looks at pre-election years with the dashed line, and then the solid line looks at all years together. And we do see some weakness here as well. And now we're looking back to being more negative with our three smart money indicators. We're still hanging on, depending on how you interpret this. Now it's been coming down, and so you might see that the accumulation distribution is turning more negative, where we are negative with the Chaikin money flow and the Chaikin oscillator. And the long-term growth to value ratio is now negative. We're back to looking negative with the S&P. We're just barely hanging on to being positive with the NYSE McClellan oscillator. The one that I focus on the most is the S&P studies here. And we're negative with the momentum. We're negative with the Swanland trading oscillator. Our moving average studies are negative. Ease of movement, money flow are negative. The vortex is negative. And our long-term oscillator, the special K, continues to be negative. Then on the positive side, discretionary to staples, but that could be under some real danger. It's still showing the 50-period moving average above the 200, but it is weakening and in the short term is negative since we continually hang out below that 200-day moving average. The parabolic SER is still positive, and we're still looking more positive with the bullish percent indexes. The ultimate oscillator is still above 50. The financial sector by itself is holding up all right. And we're looking better on a momentum basis with the NASDAQ 100, but that's even under question now with the big down day that we saw on Wednesday. And this mass index, not sure really what to make of that. We're just kind of watching that on a day-by-day basis. So our conclusion, we're negative across all different time frames. We're looking extreme negative, but we have to kind of change our thought process. When we go extreme negative in the short and intermediate term, but the long-term trend is up, we tend to not stay there for very long. Now that the long-term trend is negative, we could start staying at these oversold or extreme negative readings for longer. So thank you. Have a really good day. I'll be preparing the videos over the weekend. Um, and I hope you have a good Friday and a good Easter. But I will be talking to you again with the various videos over the weekend.